Welcome back to Palisade Radio. I'm your host, Tom Bodrovics, and joining me today is a new guest to the show, Michael Oliver from Momentum Structural Analysis, or olivermsa.com. He's got 45 years in the financial services industry. How are you today, Michael?
I'm fine. How are you, Tom?
I'm great. In your bio on your website, you have studied under David Johnston, the chairman of the Comex in the mid-70s. Could you share with us some lessons from your time there?
Well, that was back in 74, 75. Gold was legalized, for Americans in 1975. And futures trading began then at the Comex. Comex then was a physical building a few blocks from the New York Stock Exchange, later moved to the World Trade Center. They only traded, they traded copper and silver there. And then gold got introduced in the third market, and of course it boomed. At that point in time, though, gold was at a peak. It had been in a bull market during the early 70s. It peaked at around $200. But I was a novice. I came from a philosophical background and got into the futures markets because of a love of gold for intellectual reasons. I'm a libertarian background. And when gold was legalized, I looked around for various firms to join up with. And I didn't know anything about markets as such, technical analysis. I knew about fundamentals and so forth. But Hutton hired me in New York City. That was their commodity headquarters. And it wasn't like a regular training program. You just sort of apprenticed under the head of the International Commodity Division there, David Johnston, who happened to be the chairman of the Comex. And it was only a few blocks away from the Comex at the time. You could walk down there. And I went down quite often. I never went in the pits because I wasn't legally permitted to. But I used to hang around the pits and watch the action. It was quite entertaining and interesting and informative. And, of course, most pit trading is now gone by the way. But still the futures markets are there, and they're quite important. But I learned a lot of things there. But that was also during the early phase of a guy named Alvin Brodsky was a floor broker in the silver pits. And he was also the guy who went to Bunker Hunt in Texas, who was an oil man, and told him a story about silver. And, of course, got all his futures business after that and traded for him in the pits. So Bunker Hunt, who became the famous silver king during the late 70s, and silver went up to $50. Alvin Brodsky was his floor broker, and I used to watch him go into the pits. And he would often come out from lunch or something to go toward the pit. The price would rise when he moved there. So in anticipation, it didn't. But ultimately, that didn't work for Bunker Hunt because the technicals were over. They were over, and silver collapsed, and so did Bunker Hunt. But anyway, it was interesting times. And so it was a year and a half. And then I went into the retail of futures brokerage. But then in 1992, I was induced by Wachovia Bank. I was in Greensboro, North Carolina at the time. That was their headquarters at the time, Wachovia, in Winston-Salem nearby. And the head of their trust department had heard about my unusual type of work, which is not the analysis of price, but the analysis of momentum of price. And not the typical tools that you're used to, like RSI or MACD, but our own proprietary tools. And said, would you provide research to Wachovia Trust Department? And I said, yeah, great. He said, have you ever heard of soft dollars? I said, what's that? And it's where an institution generates brokerage by executing trades for their clients, like their trust clients. Commissions can be used to partly pay for research. So I was paid by the brokerage firm that they would execute their trades to. So it was an interesting change for me. So MSA began then as a research publication only for institutions, hedge funds, banks, so forth. But in 2015, we allowed it to open. We opened up for retail subscribers. And we've been in business since 92, using basically, the same methodology. Been a few improvements in the methodology, but nothing basic. You go to our website, there's a place called Method on there, and you can read about the methodology and why does it exist and what are its differences. But basically, let me try to summarize it in one sentence. I'm going to quote Wall Street Journal here because they did a fairly good job in one sentence. Quote, MSA looks at the market from a somewhat different point of view. Rather than focusing on price, something that virtually everybody does, MSA tracks momentum, revealing trends that have been building for a long time and have much more depth to them and staying power. That pretty well summarizes it. But basically, we have a distrust of simple price charts. Why? Price is a measurement based on a given fiat currency. So when you're in the U.S. and you buy a stock, you're buying it in dollars. Well, fine. So if your stock was $30 10 years ago and it's now 40, you think, gee, I'm up pretty good. Well, in real terms, you're down pretty good. Because in real terms, the real value of the underlying money unit, the measurement factor there, the dollar in this case, it's declined in value because its quantity has doubled basically every decade since 1959. So a constant degradation in the value of the money due to the quantity of money out there. And now, of course, we're into hyperspace in terms of the quantity of money that's being generated by central banks globally in the developed markets. And we think that the prime beneficiary of that, of course, will be gold. But what it means is that when you measure something, like let's say you take a yardstick and you're building, you're a contractor and you're building a house. Let's say it takes you 6 months to build it, but let's say your yardstick, 36 inches, grows a couple inches over that 6 month period, but still says 36 inches. You can imagine the unsurvivability of that house once you've completed it because of the structural nature of the distortions that are built into it because your yardstick changed and you weren't aware of it, didn't compensate for it. Well, the same is true when you look at some long-term chart of stock market or gold or anything. Quite often it doesn't really factor in or over factors in the degradation of the money unit. In the case of gold, it's always maintained its value over the long term relative to the money unit and versus other assets. So we can't totally get away from measuring versus the money unit, meaning measuring price, but we can take one step away. And what we do is we measure an asset in relation to a moving average of that asset as measured by that money unit. So it's a half a step away from using the raw price value of the asset. Because now we're referencing where is that market's price in relation to a changing average of that asset. You know, it could be a short-term average, 3 week, 3 month, 3/4, 3 year, 10 year, whatever. We tend to focus at MSA on longer term factors because what we don't want to do is to call a top or a bottom in the market. And every time there is a flinch in that new trend, counter trend move, we run for the exits. Because what will happen is you won't catch the move. It's invariable that if you exit too many times in a given trend, especially a good trend, you're finally going to miss getting back in at one point and you'll cuss yourself for having missed the trade. I suggest that the recent drop, false drop, bear trap drop that we saw in GDX and silver back in late March was exactly such a move. MSA at that time saw vulnerability. We didn't quite see how deep it would go, but we predefined it as a bear trap, meaning it's a down move that's designed to suck in bears and stop out bulls and then turn around and go back up. And sure enough, if you look at the daily action of gold, which didn't have that kind of severe drop as silver and gold miners, but they turned on a dime. And if you got out during that drop and didn't get back in, you missed it. Because then GDX was in new multi-year highs within a handful of weeks after dropping down under 20 into the 16 area. Silver dropped under 12 and within weeks was back now last month's close, a new high monthly close, except for July of 2016. It blew out all the closes of last year. And it did it in a heartbeat. So that's what we call a bear trap. But what kept us from telling people to sell and to exit their long investor positions in gold miners or silver or gold was that our long-term momentum studies of those markets said, no, this break is not valid. It is a bear trap. And sure enough, that's what it turned out to be. We are flexible. We've been bullish stocks, bearish gold, bullish gold. 2012, for example, much to the angst of many of our bullish gold subscribers, we turned major bearish on gold. That was after gold had made its high, above 1900 in late 2011. It dropped. And in January 2012, about 1650, we turned major long-term bearish because our annual momentum of gold, not price, had broken so much clear trend structure. The kind of trend structure, if you were a price chartist looking at the gold price chart, and we'll look at that later on, you would see that price didn't break anything. It just sort of went into violent congestion. But momentum broke a very clear multi-year structure. And at that point, gold floundered sideways for the next year, actually, either side of our sell point. And then finally crashed starting in April 2013 and dropped down ultimately to 1054 in 2015 in price. We got bullish based on annual momentum, not price, at 1140 plus on price of gold back in February 2016, and have not changed that long-term view since. We've added to it. So what we're looking at primarily, and again, we'll look at some of these charts later on, is not just the price action, but especially we're looking at the momentum action in the same way that a price technician would be looking at his price chart. We're looking for some of the same attributes in momentum, like structures that are broken out above or broken below. And often momentum will steer you straighter than will a price chart. Price chart is probably, I'm going to guess, 60-40 accurate to follow price technicals. Hopefully our momentum work is more like 80-20 accurate. That's our methodology in broad strokes, the method and the rationale for it. And we look at all asset categories in our asset category report. We watch the debt markets, foreign exchange, stock markets, and commodity markets, and especially have an emphasis on gold and silver and the miners.
Excellent. As you're speaking about momentum, let's really define, let's say, how you go about calculating momentum structuring versus RSI or MACD.
Oh, sure. I think maybe at this point you ought to flip up one of our gold charts. Like take the gold chart with the price on top and the annual momentum on the bottom. And what it shows is both are bar charts of monthly high-low action closes. So you got the conventional chart on the top going back to 2011. And you've got, the price chart. And then at the bottom you have our annual momentum oscillator. Now, what does the annual momentum oscillator show? How does it plot it? Well, each month there's a high in gold, a low in gold, and a close. Well, where in relation to the 36-month average was that high, that low, and that close? What percent over or under the 36-month average, which changes every month, was this past month's price action? And we plotted on the chart as a percent. So, last month's high was X percent over, its low was X percent over, and its close was X percent over. So it develops a different chart pattern, different structures often, than does the price chart. And usually momentum, before it changes trend, will break that into a new trend before it becomes evident on the price chart. So price will ultimately say, yeah, you better get out of this long position or into this long position. For example, in the spring of 2013, finally, as gold broke down to about 1520, every price chartist in the world realized all hell was going to break loose, and it did. But we had been bearish a year before and had warned, get out, get out, get out. That's around 1650. Well, reverse that at the lows. After breaking that clear momentum structure that you could see on the gold momentum chart back in 2011-12, there's an uptrend line that wasn't evident on the price chart. And again, while it broke, it didn't collapse. It took another year to finally collapse the gold market, but it did warn, no good. Now look at the bottom. Once we made our low in 2015, when you look down at the momentum chart, you'll see that gold had been in a sedate type basing action sideways on the momentum chart and had built a ceiling repeatedly at the same level on the momentum chart, X number of percent below the 36-month average, hitting it. Finally, in February of 2016, as price moved up through 1140 on the price chart, which wasn't very meaningful on a price chart, that momentum chart broke out over like a 3-year wide ceiling. That was a very clear breakout level. So annual momentum said, okay, we're no longer bearish, we're bullish. Well, nothing has happened on that momentum chart since that breakout, other than another buy signal, which occurred last summer, upside breakout through a structure, to alter our long-term bullish view on gold. Annual momentum is still quite positive. The March low, which scared people on a price chart, merely put momentum back down to what? To the top of the secondary breakout level, the flat ceiling that anybody with a crayon could draw. You couldn't draw it on a price chart, but you could draw it on the momentum chart. Anyway, so right now, when we look at the long-term momentum of gold, we look also at quarterly momentum and monthly momentum, not just annual. We come up with plus, plus, plus. So while all during the last 2 years, this analyst, that analyst, this market report, this market letter have screamed, sell, sell, sell. We've seen no reason to argue that, other than on some short-term basis. And we don't like to deal with that too much because, frankly, if we urged our subscribers to exit this or that market based on something short-term, they might miss the move because it's very hard to get back in once you've gotten out, because psychology is one factor. But take, for example, the drop last March, silver and GDX. It did panic people out. And there's almost no way that if you panicked out of that, you got back in at a ripe level, because the turn was so rapid in that bear trap that by the time GDX was blasting into new highs above 32, above 31.70, excuse me, that would have been repeated highs on the price chart, and silver was back at its highs at 18, basically. It was a matter of weeks. So we don't tend to focus too much on the short term unless it has some immediate focus on intermediate trigger or a longer term trigger. In other words, if the short term turns, could it also trigger something bigger? And that's where we'll focus on it. But we tend to try to keep our subscribers focused on not the day to day, but on the more significant trend changes.
Absolutely. And a little bit of a technical question. As we're looking at those charts, what charting tools do you use? Do you build your own, or do you use something like TraderView?
Entirely proprietary spreadsheets. Excel is our, we use Excel. Thank God for Excel, because I'm not mathematically oriented. No, we embed all our formulas into the spreadsheets, and then the spreadsheets make the charts. And, you can pretty much figure it out yourself, given what I've just described. But anyway, it's all proprietary, and so we don't. There's not a package you can buy, and you can't find it on a quote screen surface. You get your RSI free and your MACD free, but you can't find our stuff. And our emphasis, unlike RSI and MACD, which tend to loop up and down like little snakes on the screen, is not the direction. It's more the structure. Is there a structure being broken? We also look for non-confirmations. For example, if price is making a new high, is it important that momentum is or not? And if it's not, then it might be important, but it's not always actionable. The key issue is, does it break structure? Is there clear structure on the momentum chart that even a price chartist could draw a line under and say, oh, I don't want to break that? If it's not clear, probably it's not going to break, because generally our rule is, if there's not something to break, you can't break trend. There's got to be something visible to break, and it usually shows up on momentum first.
So another chart that we have, and one that I think we're all very excited about right now, especially in this space, is the silver chart. So tell us a little bit about the annual momentum monthly closes and what we're seeing from that silver chart.
Well, you see it. Get the chart out here. The 2000s, there was first off a base in silver. There's a monthly closes here now. It's very simple. Doesn't include the highs and lows. Just each month's price close, and then each month's price close plotted as a percent relationship to above or below where the 36-month average is for that month. And again, the 36-month average changes month to month, so it's a dynamic unit of measure, unlike price, which is a fixed unit of measure. Although, as we've explained, fiat currencies are never fixed units. But anyway, you look at the action in silver between 2013 and 16, and price was coming down at a slower staircase. The collapse had occurred in mid-2013, but it continued to staircase down for a couple of years. But momentum didn't. Momentum went into this quiet little sleepy base between mid-2013 and early 2016. And when it crossed up through 20%, I haven't marked that spot as a breakout, but you can see that little base broke out. And sure enough, you had an explosive up move in silver. It was like an initial, I'm alive type move, okay? And silver went up, dramatically up to about $21 actually intra-month from a level in the 13s. And then annual momentum built a trading range from 2016. And then you'll notice that the reaction lows in that little trading range that we've put a rectangle around haven't even quite set down on top of the prior base, 2013 to 2015 base action. So momentum didn't do anything wrong. Silver eroded back down almost to the lows in early 2019, late 2018 in price, but momentum didn't. And then last summer we had the strong rally in silver. Now that rally in silver went up to the 18-19 level, and it went sideways for half a dozen months. It didn't challenge price high, the last rally high on the price chart was just over 20 back in 2016. So it was yet another high in the silver market that was a lower high than the prior high on the price charts. But as you can see on momentum, that cluster of action late last year, last half of last year, was fairly close to the top end of the July peak of 2016. So almost got up there to another breakout point, but it didn't. Instead, it pulled back sharply. And in that sharp pullback, we know that price made a new low, not on a monthly closing basis. The price chart didn't on the close, but intra-month it did. But momentum sat back and tested the lower end of that range, the lows of late 2018 on the momentum chart. So it didn't break anything. And then immediately turned and exploded back above the cluster of high closes on the momentum chart and the price chart of late last year. Now, what's missing here is we've got a strong surge that we've just seen. And it did take out last year's closing highs on price, on silver monthly closing highs, and on the momentum chart. But it stopped 0.1% short of exceeding that July 2016 oscillator peak close. And as I say here, if you close out silver, a monthly close, this month or next, at 1879, which doesn't mean too much on a price chart. You look at day to day. I'm going to close out above all the monthly oscillator high closes going all the way back to 2013. So for silver, it's surged back up in price to its recent highs. But for momentum, it's surged back up to a flat level of highs that is very significant, that if it exceeds it, it's likely to explode. Now, I know a lot of people are saying, well, silver's overbought, gold's overbought, they got to collapse, et cetera, et cetera. Well, I mean, I defy anybody even looking at this price chart, much less the momentum chart, to call this overbought. Too many people are focused on the day-to-day, week-to-week, and they're not focused on the bigger picture, and hence, when the bigger picture unfolds, they're going to miss it. And another suggestion is, aside from the time scale that you're looking at as an investor, is to focus on the longer term, but it's also to look out the side mirrors at the other asset categories, because that's what we do at MSA, is we show not just the technical, but also a fundamental gear shift between the various asset categories, inverse, sympathetic, and so forth. And usually early in a major trend, smart money, and that's not always the same guys, okay? But smart money, people we look back and say, boy, they were right, usually gets in first, and before it becomes bleeding obvious to everybody else that should have gotten in this market or gotten out of that market. And we measure that via spreads, and we don't have any here to show, but the spread is simply a measurement of let's say the price of gold versus the S&P 500, for example, or the price of silver versus gold. Which is doing better when you plot them on a differential, a spread chart. The price of gold measured as a percent of the S&P and so forth. And we can tell that despite the recent stock market rally, going back years, that gold has now broken out above a base. Remember, gold has underperformed S&P since 2011 and vastly outperformed the S&P for decades, but with downswings, such as we suffered from 2011 to 2016 on gold price. You also suffered a relative performance downturn. But since 2015, when you measure gold versus the S&P, it's really gone sideways, which most people don't realize. Gold has advanced a decent percent while the S&P has too. So it's kept pace with the S&P on a relative basis over the last several years. Well, in February of this year, gold broke out of that base. So the relative performance of gold is now positive versus the S&P, despite the S&P rally. It tells us that smart money has begun to exit the S&P, questioning its safety and its long-term efficacy, and move more into other asset categories. And one of the prime asset categories, the alternative is gold. Another one has been T-bonds. T-bonds since late 2018 have had a very strong up move, a drop in yields. And we argue that since late 2018, when gold was moving up above 1,200 and when T-bonds were moving up into the 140s, T-bond futures, that smart money was saying this stock market doesn't cut it anymore. And sure enough, during that period of time, we've had up and down in stocks, but a net zero, where money is being teased both ways. But actually, our argument is that technically the S&P has broken its backbone. So have the other developed indices of the world, despite this rally. But the smart money during that time bought gold and bought T-bonds. And sure enough, at the March low in the S&P, the final panic few days, gold and T-bonds also sell off, which confused people. But actually, I think what was going on was in the brief sell-off to gold, it was really 3 days in gold and several days in T-bonds. That sell-off, which seemed to be coincident with the S&P sell-off, was actually anticipation by smart money that the stock market was about to turn up for a rally. And therefore, there was no need to hold on to my gold or my T-bonds if the stock market was going to rally, because the stock market had just made a panic low. Well, one day off that low, we called the S&P upturn. One day off the low in March. We only defined it as an intermediate upturn. Certainly weren't bullish on the S&P. We argued if you're short, exit. Don't go long unless you're a trader. But what's interesting is that though bonds and gold seem to collapse in anticipation of an S&P rally, why didn't they stay collapsed? The S&P's produced a nice rally, yet gold went back and made a new high as an alternative to the S&P. T-bonds went back up to their high and stayed there. So for the last 2 months, what's happened on T-bonds, if you look at a month-to-month or weekly closes, for example, ignore the intra-week stuff, you'll see that bonds have been in a sideways walk, very unflinching little range. So that's been true with the gold weekly closes. You know, they've been above 1750, below 1750, but just sort of sideways with a lot of little torrents up and down, but nothing really going on. And yet the S&P has continued to rally. Why haven't gold and T-bonds stayed down? Because we think the smart money that bought into those alternative markets says we don't believe the S&P rally, and we still don't believe it. So we'll see if they're right. We think they're right. Ultimately, we think the T-bonds are not going to succeed in the long run. We think that they'll turn into a bear. Yields will go up. But for now, we think that the alternatives of T-bonds and gold, which were basically the only alternatives over the last year, will still persist as alternatives to the developed indexes of the world.
As we're talking about the S&P, there's a recent interview late last year you were talking about the biggest trade of the century in the stock market. Do you think we have seen the final crash, and how do you go about analyzing a possible second leg down in general equities?
Yeah, we in the history of stock markets, 100 years, we predefined this collapse last July. We said that if you drop through these levels on annual momentum, and of course we were 9 months before the event, we said that these are the structures, but they're not broken. And the market continued to advance from last summer through late last year and into early this year. But in February this year, as the market began to turn down, not far off its highs, we blew out all kinds of momentum support structures that were very clear on momentum, not on price. Quarterly momentum, monthly momentum, and annual momentum. So we structurally broke the backbone of the upside since 2018. In fact, the S&P broke through all oscillator lows on annual momentum going back a decade. Not the 2009 low, but every low since like 2010 onward. So annual momentum is like a destroyed chart of S&P. And this is true with all the indexes of the world in the developed economies. This rally does not change that. It's a counter trend rally, and it's impressive. And I know a lot of people believe it's going up forever because that's the mantra. And the Fed has our back. But our analysis of long-term momentum says no. Now, what's happened in the past with crashes is that our view is the market bear trends either starts with a crash, talking stocks now, or it ends with a crash. So, for example, in 29, it began with a crash, and then you had like a 5 to 6 month rally back toward the 29 highs that didn't peak till, I think, May of 1930. So it was a lot of months of feel good where the market was stable. And even the president at the time, Hoover, came out and said, everything's okay. We're over the worst. And of course, he about said that at the peak of that bear market rally. The market then rolled over in 29, but it wasn't until October of 1930 that it was able to ever take out the crash low of October, November of 1929. So you had your rally, it withered, but you never crashed again, and yet the Dow went from the upper 300s to near 40 by 1932. And the rest of the bear market was never a crash. It was just an arduous zigzag trading type decline. It just took all the blood out of the market. Well, you go back to 2000 dot-com peak. We had a crash there. The Didn't show up in the S&P, but it showed up in the NASDAQ. And it was April, May of 2000. The NASDAQ dropped like 30, NASDAQ 100 I'm speaking of here, which is the internet tech-heavy front end of the market. Collapsed like 35 to 40% in a matter of several weeks. That's a crash by definition. It wasn't a 20% pullback. It was a 30% plus, similar to the percentage of 29. But then what happened? Well, starting after I think it was the May low in 2000, the NASDAQ rallied. It never made a new high, but it rallied and hovered off that low until like late summer of 2000. And it wasn't until late in the year 2000 that it finally took out the low that it made early in the year. But what happened between there and the 2002 low was an arduous, boring, but deep bear market that wiped the NASDAQ like a 90% wipeout. So the crash came at the beginning, but that didn't prevent the full bear market. Now, 2007-8 was a little different. It had a sharp drop in 2008, January, February, but it really wasn't crash dimensions. But at that point, it did break all of our annual momentum and quarterly momentum support structures. So we knew that the S&P was in a bear market. And then you rallied into May 2008. And remember, all during this time, for those who love the Fed and think the Fed has your back, Bernanke, starting from the late summer of 2007, had the back of the market. He knew there was problems. He denied there was a housing crisis, but he explicitly, and even in statements, went in to save the stock market. Were they able to save it? No. The market ultimately crashed. The crash came late in the 2008 break. It came in October 2008, a few months before the final low in March 2009. So right now, we tend to think, yes, the trade of the century is over if you call it a trade, meaning the crash effect. But the bear market that's to follow, I think, could be arduous, bloody, and deep, but not easy to catch unless you're unleveraged and flexible. We think it'll be arduous. Our focus right now as MSA is not to scream, sell the S&P, but we think the next decline in the S&P will further cause other asset categories to do different things. In the case of gold, we think it will further enhance its uptrend. Why? It's obvious fundamentally, and also the technicals look good. The central banks are now in full panic mode, and they are not coming out of full panic mode. At least with Powell, we have an honest Fed chairman, unlike Bernanke, who denied there was a housing crisis and talked cheerfully all the way down. Powell is panicked. You can read it in his recent speeches, in the tone of his speeches. He sees a situation where the Fed has full throttle and is begging Trump and the federal government to print, to pay checks out, and so forth, whatever it takes. Why is he so panicked? I think he knows why. I think El Arian, for example, who was on TV, last week, he said this is not something that could be solved by, going back to the shops again. This is much bigger. He says they have to keep, not just the Fed. He said the Fed, like Powell knows, have done everything they can do. Now the central government has to print money in the form of paychecks. Our argument in MSA, and we haven't really made it yet, I'm going to do it soon, is that this crisis has very little to do with the coronavirus, and also now very little to do with the riots. Unfortunately, the market's rallying while the riots are going on, meaning you're not getting sellers who are selling the news. It's always the worst way to go down. But these are indicative of the underlying problem, and the underlying problem is that at least for 12 years, since 2007, and you could really go back decades, but let's just take it from that far. The Federal Reserve, the ECB, and the BOJ have been disencouraging savings and encouraging consumption. They've driven rates to levels you can't make a yield. This has hurt pension funds, it's hurt retirees, it's hurt all kinds of people and companies included. And yeah, while it's helped the stock market, it hasn't fundamentally helped people. So wouldn't it have been better had they encouraged savings, had rates up where people could get a yield instead of trying to stimulate the stock market, where people at the peak of the panic problem could sit back and say, yeah, if my wife gets laid off as a hairdresser, I'm still working, but we've got 6 months worth of safe money, so we could survive a couple months. We're not in panic mode 2 months later. Well, they are. And we all know the studies that have been done, what the family can afford so much panic money, $400. They can less afford it now to pay for some family emergency than they were in 2009. How come? Well, because of central bank policy, central government policies around the developed world that have discouraged savings and encouraged spending. So now when you need spending, you ain't got it. So we think there's some fundamental tsunamis about to hit. We're in one of them right now, and it's not the riots. The riots are indicative of the underlying problem. And that is the suspension of rent payments, both by, businesses, and shopping centers and families, has been in place for a couple of months. Well, now the landlords can sue you in court and have you shipped out if you don't pay the rent and maybe even the back rent. Well, the question is, did that policy really help people? And are they better off now in June to pay that back rent and to continue paying forward rent or not? Well, you can read it in the face of Powell and the face of Valerian the other day. They're not. Well, what's that going to do to social order? And also, what's that going to do to government policy? Well, I strongly suspect that government policy, you're going to look back and by next year, and maybe even before then, look at all the policy statements made by Bernie, and they're going to be in effect. Not that he gets elected, but that regardless who gets elected, I suspect one policy they haven't thought about is the suspension of income tax, which, remember, Trump has delayed and even mentioned he might push it off till late in the year. And I think the reason for that is they full well know that the people who couldn't pay in April or might not have been able to pay based on their good 2019 income and they owe taxes on it are no better able to pay now and probably worse off than they are now. So for political reasons, he might want to put that suspension off till later in the year. And once you do that enough times, kick the can down the road, people can say, hey, maybe they're just going to suspend it. It wouldn't shock me if they do. I would also expect Trump, for political reasons, to get the student vote to, all the student loans are forgiven. Either that or, Biden's going to pick up that mantle. That's one of Bernie's things. Why? Because they can't pay him anyway. So what's the difference? Just have the Fed write a check, buy some bonds, pay for it. The other issue is if income doesn't come back for people and social disorder sets in more or less permanently. I don't mean on the scale we're seeing now, but, the turbulence, the sense of unease. The idea of guaranteed income could be a policy that comes into place. Well, all these things, if I told you that a year ago, and frankly, we expected these repercussions, these type of repercussions, this trend direction and fundamentals to follow the collapse in the stock market, it being like the bellwether, the artificial bellwether. These things mean, you don't have a capitalist economy anymore, not that you had one anyway, but to the extent you had one, it's going to be even more diminished. You're going to have a fully regulated, fully paid for, socialized economy. Well, that changes all the fundamentals, all the measurements, everything. And certainly the measuring unit will be changed in terms of its quantity. So, when I was a kid, a loaf of bread was 19 cents. It's now, $3.70. Well, it isn't because there's a shortage in wheat. Okay. And a loaf of bread might be $7 in a year. Not because there's a shortage of wheat, but because the finally smart money started putting money out of stocks back into the commodity category. Anyway, these are the kind of dynamics that are in play out there, many of which will come into play.
Excellent. That's a very, very broad view of some of the factors that are really going to come into play here soon. I'd like to step back just to go back to gold and silver a little bit. Before the call, we were speaking about, for example, the GDX and what you're seeing there. Well,
the GDX, of course, is tended over history, or the XAU index, which has been around since the 1970s. We look at long-term and stuff, so when we go back a long time, we look at XAU index. But GDX is clearly the most popular gold silver mining index, ETF out there. So we measure it most of the time. But it's definitely outperformed and then collapsed in the 2011 through 16 period and underperformed gold. And now our argument is it's shifted back to outperform now in recent months. And therefore, that's an indication to us that some serious outside money has begun to flow into that tiny little sector. And it's a tiny sector. So when money flows into it, it can move it a lot. But we also noticed that GDXJ, the juniors, which I know a lot of people have interest in, just like they have a lot of interest in silver compared to gold. It's the poor man's metal, and junior miners to some extent that same relationship to GDX. They've been underperforming GDX and continue to, though they firmed recently, but on a basically on a broader scale level, we measure the spreads of the two. And it won't take a lot, but GDX is still underperforming GDXJ is still underperforming GDX on a relative gain basis. It's going up, but it's not going up at the pace of GDX at this point. But we can see in the technicals the potential for that shift to occur. And we think once that shift occurs, the trend in gold and silver will then move into a more midstream trend, meaning it's more obvious to more people. Right now, I think the reason for the focus on GDX by investors is that some of those investors are asset fund managers, hedge fund managers, large investors who've been around a long time and who aren't necessarily gold bugs. And they've decided they need to be there. And if they can't invest in gold, given the nature of the fund, they'll go into miners. But they're not going to buy the little guys, the $1, $2 miners. Too much legal risk in that. So they buy the Barracks of the world and the Newmont Minings and the Pan American Silvers. So their emphasis is still on the NDX, and I think that's why it's behaving well, but behaving better than the juniors. But once we see a shift in the GDXJ versus GDX in terms of relative performance, that'll indicate to us that we're reaching a phase in the trend that's further wind at the back, meaning more and more investors are coming in. But because they'd like to own more stocks, more shares, or they want to own more ounces of the metal, silver than gold, they're going to shift their emphasis into the junior miners and silver. And that those two markets will then begin to outperform gold, and the junior miners will outperform the major miners. And we think that'll be indicative of that new class of investor finally getting behind these markets. We think we're still in the more emergent phase where it's the smart money now at this point, and that the less smart money will join in later. And that's one exhibition of how that'll be measured.
Excellent. Well, that's some good stuff to look forward to. Michael, do you have any final thoughts as we wrap up here?
No, I just think you've got to look at the broad. It's hard to integrate fundamentals, I admit, and we try to not do that. But we think these fundamentals are bleeding obvious, and I've hinted at some of them. But I think they're all correlated to longer-term fundamental factors and trend factors that are showing up in technicals. We argue that the long-term trend of the developed market indices, going back to the 2009 low, has been broken. We think the long-term trend of gold is broken out upside. And when we say long-term trend, we mean annual momentum. And generally, the annual momentum trends don't go up for a year or two. They go up for 5 or more years sometimes. And we're clearly not at levels in terms of long-term momentum on gold or of silver that are at least a bit overbought, not the least bit. So when these people are screaming, the market's overbought, it's going to crash, we've had a couple of those. How many do you want? We just had one in March. We had a panic crash of 3 days, really most of it 3 days. It took gold from 1700s, 1400s. Next thing you knew, your new highs. You're back to the highs again. So, it's people are looking for this all the time. Pretty soon they need to stand back and look at the bigger picture, like, the silver monthly chart, monthly close only price chart, or the silver annual momentum, or the gold chart, that it causes you to slow down a bit and not be so panicked. And then look at the context, look at the decaying pattern of the S&P. Yes, it's rallying now, but it's really been nowhere land for a while, and it's certainly confusing. To us, it's not. It's a bear market, having a bear market rally like in 29 to 1930. But other markets, also the dollar. The dollar has not been a factor in the gold. In fact, gold has advanced strongly with a slightly firming dollar over the last 2 years. Now the dollar's starting to break down. In fact, it's about 2 points away in the dollar index from going down big time. We've got some specific numbers we've defined not far below where we are now. If it shifts out of a sleepy upside mode into a rapid downside mode, the dollar will suddenly become a contributive factor to the gold and gold miners. So you've got to keep your eye wide. Don't just look at the day-to-day in gold and silver. And that's our best advice.
Excellent. Well, we appreciate all your advice and your insight, Michael. Of course, the best ways to find you are olivermsa.com and at Oliver_MSA on Twitter. Anything else you'd like to add?
Nope. Thanks a lot, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.
think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?